So hello everybody again and welcome to the 11th ReCap webinar. Today's webinar is entitled How Fintech Will Transform Banking if Politics Permits It. Our speaker is Professor Charles Calomiris from Columbia University. Charles is the Henry Kaufman Professor of Financial Institution at Columbia Business School, Director of the Business School's Program for Financial Studies Initiatives on Finance and Growth in Emerging Markets, and a professor at Columbia School of International and Public Affairs. His research spans the areas of banking, corporate finance, financial history, and monetary economics. He's a distinguished visiting fellow at the Hoover Institution, a fellow at the Manhattan Institute, a member of the Shadow Open Market Committee and the Financial Economists Roundtable, and a research associate of the NBR, and a senior fellow of RCA. Charles also is past president of the International Atlantic Economic Society and has served on numerous committees, including the Advisory Scientific Committee of the European Systemic Risk Board, the US Congress International Financial Institution Advisory Commission, the Shadow Financial Regulatory Committee, and the Federal Reserve System Centennial Advisory Committee. He is the recipient of numerous awards and research grants. His recent book, Fragile by Design, The Political Origins of Banking Crisis and Scarce Credit, received the American Publisher 2015 Award for the best book in business, finance, and management, was named one of the best economic books of 2014 by the Financial Times, and one of the best books of 2014 by the Times Higher Education Supplement and by Bloomberg Businessweek. Today, Charles will tell us about fintech firms that are providing banking services. Fintech firms have proved to be more efficient and profitable than existing banks, and also more inclusive of customers that are poor or members of minority groups. The next generation of these intermediaries could prove even more effective at delivering beneficial services, unless they will not survive the political attack by status quo special interests, aiming to kill off new intermediaries with prohibitive regulations. Without further ado, Charles, the floor is yours.
Thank you very much, Claudio. I appreciate the kind introduction, and it's a privilege to be able to present this to all of you today. I think I should start by giving a little background of how I came to work on this topic. And I think I would say there are two things that are worth mentioning, probably. One of them, Claudio just mentioned my book, Fragile by Design, and the subtitle of that book is The Political Origins of Banking Crises and Scarce Credit. And I want to emphasize something about that book that I think is surprising for many economists, which is, it's been a long time since banking was invented. I think we could say that by 1750 in Scotland, the modern banking system had been pretty much perfected. All of the things that we think of as key technological ingredients of banking had been developed and perfected in Scotland by that time. Deposits, loans, even lines of credit, branch banking, clearing houses, all of those things that are sort of the key attributes of basic banking systems. I'm not talking about underwriting securities, that didn't exist on a widespread basis yet. But in terms of payment systems formed with deposits and a credit system, it was all in place. And what's interesting, what Steve Haber and I noticed at the beginning of our book, Fragile by Design, is this very simple technology that should be very easy to diffuse all over the world, still 2.5 centuries later, is not really widespread. That is, in most countries in the world, we would have to say that the banking system, let's say supply of credit as a fraction of GDP, is a trivial number. Actually, there are very few countries, a very small percentage of countries, that seem to be capable of building a banking system that has depth of credit, and even fewer that manage to have depth of credit and some sort of reasonable stability. And I want to emphasize that the stability and depth of credit really are not that hard to do. That's one of the points of our book, but that they're still, it seems, not chosen by the political systems of many countries. And so from that perspective, we shouldn't be too surprised that good technologies in banking may not come into existence. And that was one of the sort of foundational points of what I'm going to talk to you about today, which is, we shouldn't take for granted that just because technologies are very helpful and could be so good, both from, in this case, an efficiency perspective and an inclusion perspective, we shouldn't take for granted that they're going to actually be adopted. In fact, the rule in banking history is good technologies tend not to be adopted. They may be adopted by some, but not as widespread as they should be. The second background is that about 3 years ago, I was here actually in Colorado, where I'm talking to you from today. And I got a call from my friend Brian Brooks, who'd just been appointed acting comptroller of the currency. And that means the head of the regulatory system for the national banks. And he said, oh, I'd like you to recommend a student of yours to be my chief economist at the Office of the Comptroller of the Currency. And I said, well, what do you want to accomplish? And he said, I want to modernize the bank charter. I want to bring fintech and new banking technologies into the chartered system to modernize it. And so I told him, no, I'm not going to recommend a student. I'm going to come myself to work for you because I think this is so important. And when I got to the OCC, what I found was that there was a tradition there already of the last several comptrollers of various political parties that were extremely keen on modernizing the banking charter. People at the OCC recognized that there's a problem in the banking system in the US, which is almost no entry has been happening for quite some time, and that banks are being displaced by competition coming from shadow banks. And if we want to maintain a relevant banking system, we have to open it to think about expanding the charter beyond what the status quo has been. I'll talk a little bit about that, but it really means many different things. Allowing banks to specialize in doing things that aren't part of the traditional banking model, like crypto custody. And we did charter some crypto custody banks, but also allowing them to bring new business models in lending or in payments that aren't like the traditional banking system, allowing them to also specialize and not have to do all the things that we traditionally expect banks to do. And that might seem like a trivial thing, but the truth is, it's very difficult because changing the definition of the charter to allow it to be more open to new technologies receives huge opposition politically. And the opposition is from a variety of groups, which I'll talk about as we go on. So that's a little bit of background to how I came to this topic. And so let me now start with some facts. So Claudia mentioned the new sort of shadow banks of the fintech system seem to be operating more efficiently. And by the way, let me just define fintech from my first slide. What I mean by fintech is any financial intermediary that's using new technology to produce financial service. And by that, that can be a custody financial service, a lending service, or a payment service. So it's a very wide and diverse group of intermediaries. What we learn when we look at these intermediaries is that, of course, there's been a sort of gradual process, but there's also been a sudden process. Since about 2013, both on the lending side and on the payment side, the fintech firms acting as shadow banks have grown their market share remarkably. And I'll show you a couple of graphs about that. What I'm going to do is, after talking a little bit about fintech in a general sense and why it has such great advantages, I'm going to then do a little bit of a deep dive into a futuristic discussion of what the role of stable coin could be, particularly on the payment side, to really improve both efficiency and inclusion. But as many of you, I'm sure, are aware, this is part of an intense political debate right now in the US. President Biden established a working group to examine stablecoin, and I'll talk a little bit about the politics of that when I get to it. but let's just say it's a highly uncertain, politically uncertain future, that is whether stablecoin will be permitted. I should also say, a lot of people who aren't specializing in this area or aren't thinking about it might think that you can do coins, or you can do payment systems, or you can do credit out in the cloud somehow. And I want to emphasize that's not true. Just as we learned from how much Russia today can control information in its own country, and we know China does too, governments, if they want to, can shut these things down because all of them have ultimately a destination, which is to a laptop or a PC. And that means that they exist physically, not just in the cloud, in each country, and they can be shut down. So you really do still need government permission to operate these futuristic kinds of payment systems that are being explored. And that permission may be withheld. We need to take that seriously. I'm going to also talk, as I said, when I talk about stablecoin, I want to emphasize this has nothing to do with Bitcoin. Bitcoin, I won't talk much about, but I'll just say briefly, is I think pretty much a useless future technology. Bitcoin was of course a great path breaker, but it's not viable as a transaction technology. First of all, because of its physical limitations, I won't go into those from an engineering perspective, and its limited quantity of coin, which comes from its algorithm, and as well as its speed. But there's another more fundamental thing, which is any kind of system in which people will want to put hundreds or thousands of dollars on a long-term basis, like a checking account, to keep as a store of value, which they can use for transactions as those transactions arise. Any kind of account like that cannot have this kind of fluctuation in value that Bitcoin has. So if we're going to be thinking about any kind of serious future banking system, Bitcoin simply can't be part of it. People want to be able to put money into an account where they know that it's going to be there when they need to spend it. That's what liquid balances are all about. And of course, that's why stable coins have been growing so rapidly as an alternative to deposits. So I just want to emphasize, I'm not going to talk about Bitcoin. I think it's a fairly irrelevant technology at this point going forward. There's lots of good empirical and theoretical work on Bitcoin that I think suggests that the reason Bitcoin was valuable initially as a first mover is that it allowed you to execute certain transactions that you couldn't otherwise execute, like let's say sending money to your relatives in Venezuela. But notice that the way people do that is they buy Bitcoin, then they transfer it to their relatives, and then their relatives immediately sell it. Nobody is holding large balances for transactions purposes of Bitcoin. They're holding it maybe for speculative purposes for long periods, or they're holding it for just a quick moment so that they can make an international transfer that would be otherwise difficult, or a criminal transaction. So Bitcoin really is not very relevant, but stable coins are, which is why I'm going to spend some time on it. Okay, so first of all, I said since 2013, things happened really dramatically. So you can see from about 2013 to about 2017 is when the big surge happened. That's a very short period of time when personal loan balances, the market share by fintech firms rose from about 5% to about 40% almost, 35 to 40%. And that's a very dramatic increase. And you can see the banking system is declining in its market share. And if you look beyond just the banking system, even some of the other kinds of intermediaries, credit unions or finance companies more broadly in the US, not just chartered banks, you can see that this is not just about banks versus other kinds of intermediaries. It's really about the technology. That is, traditional finance companies that aren't part of fintech have also seen a decline in their market share. So this is clearly a story in the shadows that are taking a lot of the loan market away from traditional banks of all kinds. Furthermore, I would say, although I didn't prepare to show you some slides on payment system, I think everyone's familiar with the growth in payment systems, transactions that have been happening, PayPal, Venmo, technologies like that. And I want to emphasize, though, that although they've taken a lot of market share, that they're really still building themselves on the banking system. They're piggybacking on the banking system and operating as a convenient way to transact, but still doing their clearing ultimately through the banking system plumbing. What makes the example I'm going to talk about later of stable coins different is this would actually completely work around and separate from the banking system payments. That is the very centralized payment system, which is intermediated by banks and by central banks. So that's what makes it very different, interesting, and really capable of delivering big benefits, unlike the Venmos and PayPals of the world, which are still piggybacking on a very antiquated and expensive, and I would say insecure and centralized payment system. So the real promise of the payment system piece of this is yet to come, I would say, but really depends on all of those advantages of moving away from the current payment system. So now let me talk a little bit more theoretically about this. What's underlying this technology advantage that's creating this increase in market share on payments and lending so far? And the thing I want to emphasize first is the importance of unbundling. Internationally, bundling in banking actually increased in the 1980s and 1990s. By bundling, I mean combining different financial services within the same intermediary. And of course, banks have traditionally bundled deposit taking and lending. In fact, I guess my most cited articles are largely about the bundling that took place in the 1980s and the 1990s, and arguing that there were efficiency gains from that. I'll come to that in just a minute. But what we're seeing now is quite a reversal. As fintech firms that are capturing this new market share, we see are specializing either in lending or in payments. So they're not only are they not doing underwriting and asset management alongside deposit taking and lending, like traditional banks in the US came to do in the 1990s and afterwards. They're not even doing lending and payments together. And of course, they're also, even within lending, what that means is that since they don't have deposit balances that they're using as a source from funds, they have to come up with their own sources of funds in the market. And if they're doing payment system, they're doing the payment system as a standalone business, not as something that's just providing cheap deposits or cheap transactions accounts for to fund some kind of lending. So this is the interesting phenomenon. Why are fintech firms, unlike traditional banks, unbundling their lending and deposit or lending and transaction services? The first thing, of course, to note is that we teach in economics that, generally speaking, bundling is not a good thing in the world. We think of conglomerates as often being inefficient for, I'd say, three kinds of reasons. One is when you do many things, the people who are running the firm can lack managerial focus. They can get too distracted by trying to understand many different lines of business rather than really focus on just what they're best at, where their comparative advantages as a firm. And secondly, there can be problems of organizational complexity, that even if you have a good strategic sort of understanding of these multiple businesses, there may just be complexity that is sort of multiplicative in the number of different lines of business you do. And many people have pointed to banks particularly as having a complexity problem of organizational structures that also tend to be multiplied, those costs, by regulatory costs associated with the regulators trying to deal with that complexity. And then third, there can be agency costs, where if you're running multiple businesses, you will have a tendency to subsidize some and tax others. That is, to subsidize the weak ones and tax the efficient ones as part of sort of minimizing disruption within your overall firm. But that can be very inefficient, and it can lead to bad internal incentives that support losers. So generally speaking, in economics, we tend to think that bundling is not a great idea. And so it's worth asking, well, then how did we ever come to believe that bundling of traditional intermediaries made sense? And then how can we understand why fintech firms have been engaged in unbundling? And I think that when we think about any of these kinds of costs and benefits, it's important to recognize that the costs and intermediation are of two kinds: physical costs and information costs. So one advantage that is bundling is that physically it just makes it easier to run your business if your lending is being funded by your own deposits. So you don't have to go to the market and raise funds constantly to lend them out. You manage it more cheaply because you have physically direct possession of some funding source. And the second point is information. And there are two classes of stories out there about how information can promote bundling between loans and deposits. One is my own paper with Charles Can that looked at the incentive advantages of keeping banks on a short leash from having them involved in deposit taking as their funding source. And a second set of papers by Mester and Nakamura and others focuses on how you can learn information about your clients by watching their business on the deposit side that can inform your lending decisions about them and managing your risks and monitoring their progress. And so I think that we had, therefore, some pretty good stories about bundling that relied on physical costs and informational costs of various kinds. And what's really, I think, important here is that technological changes associated with fintech have been lowering the information costs and the physical costs that tend to advantage bundling. And I think that's a key part of why the unbundling in fintech is happening. So let me emphasize a few examples of this. So first, there's a firm that was operating in the UK very successfully as a small and medium enterprise lender called Oak North. The way it operated in the UK is scraping the internet with maybe thousands of different databases. And so there's huge sort of upfront cost to constructing this platform, but it scrapes the internet so that it has real-time monitoring of all the information that one can get on the internet, and then translating that into what its implications would be for any particular firm. And what was remarkable about Oak North's experience over the last couple of decades or so is that they had virtually no non-performing loans. And the reason is that they were able to anticipate challenges and problems in their portfolio firms even before the managers of those firms were aware of them. Go to those firms which they had lent to and talk to them about problems that were coming up and find solutions that were in the interest of the firm as well as the lender. That technology came to the United States, and initially, I don't know if they've changed their strategy, but initially Oak North doesn't actually do lending in the US. It just provides its platform for small and medium-sized lenders, and it's growing, from what I understand, quite rapidly and quite successfully as people are learning that they have an enormous amount of information, much better than they used to, in anticipating and dealing with problems. And so obviously you don't need to monitor deposits of your customers if you have this kind of information that can anticipate things and can understand their business so deeply. The other thing I want to emphasize is on the physical cost side, especially when we're looking at small transactions, let's say small dollar loans in particular, there's some transactions that traditional banks can't even compete in potentially. Let me give you an example. Suppose you came to a bank and said, I want to borrow $20 for a month. So you think about that, $20 for a month is very hard for a bank to lend you. And the reason is just to fill out the application for your loan and to do a credit check on you takes so much time that it costs more than $20 to the bank. So in order to get that business, the bank would have to charge you for 1 week, an unbelievably high interest rate that would recover its own transactions costs. Whereas, and so that the sort of fact that the banks are operating this very large physical network and they're doing things through traditional kinds of labor and walking into branches and that sort of thing, just means that they really almost by construction cannot compete for certain kinds of small dollar payments or small dollar loans businesses. Whereas if you can access an intermediary online and be able to overcome the informational barriers that might prevent someone from lending to you a small dollar amount, if you can do that, the physical costs are virtually zero. And now we can see, and in fact, we are seeing, as I'll talk about in a minute, we are seeing intermediaries that are able to lend very small amounts at very low cost to customers. And this is very important. It's a great efficiency gain, but it also is a financial inclusion gain. Something like 20% of people in the US don't have banking accounts or any transactions with banks. They tend to be poorer. They tend to often not have English as their best language in some cases. And what the online banking has done is sort of open up new opportunities in banking for this 20% of unbanked. And some people would say that the number is maybe twice that as a percentage when you include what's called the underbanked as well as the unbanked. So this physical advantage, of course, is really quite remarkable and big for small transactions. Another physical cost issue or informational cost to some extent, but mainly physical cost, is just as the markets for securitization developed, especially in the 90s and the 2000s, it just becomes much easier for institutions to set up without having their own deposit business. And the reason for that is that they can access markets so efficiently. And I think it's also worth noticing that a lot of this growth has been happening in an environment, the last decade, really more like the last 15 years, where interest rates are extremely low. And if you think about that, what that means is that the advantage to traditional banks from maintaining their deposits has traditionally been that they pay lower interest than the wholesale rate on those deposits. And so the cost of the branching system is supposed to be defrayed by the benefits you get from this slightly lower interest rate than the wholesale rate. But when the wholesale interest rate is zero, and in the US, we still have a zero lower bound on the payment of interest rates. Intermediaries don't pay negative interest rates. I know that's happening in some places in Europe, but not in the US. And so what that means is that the advantage that you got from having these cheap deposits has gone away for many years now. And so that also offers, the timing I think is interesting, that it's offered an advantage. If you can figure out how to access the wholesale markets, you really don't lose anything by not having a deposit transactions-based system as a source of funding. So when you put all of this together, I think this helps us understand that the new way of doing things really doesn't require bundling. So I think it's clear that incumbent traditional banks' market share will continue to fall. I would say that's true even in a rising interest rate environment, despite the fact that low interest rates certainly have helped. But I think the real issues about the costs are much deeper than the temporary issue about the interest rates. So I think shadow banking, or let's just say fintech, which so far has been done mainly as shadow banking, will continue to rise. That also means that if we want to regulate these activities, let's say for consumer protection as well as prudential regulation, we're going to have to focus more on regulatory apparatus that operates at the level of the product or the service rather than at the level of the intermediary. And we've done that in the US, shifting to, let's say, the Consumer Financial Protection Bureau, which is working on activities rather than intermediaries, in contrast to, let's say, the OCC or the Federal Reserve or the FDIC, which are regulating the actual intermediaries. Nonetheless, I think it's still fair to say that if the shadow banking system continues to be the place where all this growth is happening, we will see a less regulated banking system. And I'm not saying that there aren't some advantages to that, but there certainly are some disadvantages to it too. If we can have a well-designed regulatory system for consumer protection and prudential regulation, there clearly are some benefits associated with that. And those are something that we seem to be losing our grip on. So my own view, and this takes me back to the theme of what's going on at the OCC and other places, is that we've had almost no entry into banking. We're losing membership, we're losing market share. And so from a bank chartering standpoint, it makes a lot of sense to modernize the bank charter to allow new cost-saving activities of unbundled intermediaries doing things that we haven't seen before to happen, to be allowed within our regulated banking system. And as a historian, I can tell you that history is full of such examples of changes. Our existing national banking system wasn't set up to do depository banking. That's something that happened as a consequence, I would say, largely of the creation of the national regulatory system in the 1860s. So we need to be flexible if we want to be relevant as chartering authorities. The big benefits from chartering under the OCC are it gives banks a national platform so that they're regulated by the national authority, and they can choose whichever state they want to locate in, which can also have some benefits. They can choose states that have some, which do have some regulatory power. But the point is, if you get to choose a national charter and you get to choose which state you headquarter in, that really creates, I'd say, very favorable sort of competition within the banking system. So what's the big advantage of the charter? I think there's a few, but the one I would like to just emphasize is the monitoring. Having an independent examiner looking, let's say, at your algorithms, if you're a fintech intermediary, looking at where your account balances are kept, your reserve balances in particular, looking to make sure that your commitments to your customers are actually credible by seeing whether they're embedded in your algorithms. So there's a big advantage, I think. So I think it's a win-win. I can tell you from being at the OCC, many firms were extremely interested in getting an OCC charter. They saw exactly those advantages. What's the problem then? Well, the problem is that there are very powerful losers who want to try to cast fintech as too risky, too new, shouldn't be able to be permitted. The charter should be reserved for these traditional banks and for the traditional concept of banking. And of course, you will already anticipate one of the members of this coalition, but I want to emphasize it's a three-legged stool that's really holding up this coalition that's opposed to progress right now. One of them is the largest US banks, because of course, they are very worried. They are very inefficient as bundled intermediaries. They have a huge amount of regulatory burden. They have very backward practices. They're not very profitable, and they don't want to have to face competition now. It's bad enough if it's coming from the shadow banks, but if those banks were chartered and then had the advantages of the platform I just described, they would be all the more powerful. But that's only one of the three partners. The other partner is the Federal Reserve Board, which sees the development of fintech really as a threat to its own power in regulating holding companies, because that's what the Federal Reserve Board does. That's the part of the Federal Reserve System organized and operating in Washington, D.C. And also because the Federal Reserve System, which the board oversees, controls the existing payment system, which is really an extremely backward, really 19th century system, much more backward than that of Europe, which operates on a very centralized basis with huge inefficiencies and delays. It's very vulnerable, as New York Fed researchers have recently pointed out, to potential hacking. And so the Federal Reserve Board is in a position of vulnerability, and it is a power seeker, in case you didn't know, and it knows that fintech could threaten some of its power. I'll explain more about that in just a minute. And then the third group are activist organizations operating out of the major cities that really are currently in a partnership with the largest US banks and get lots of off-budget fiscal policy effectively through the regulatory system of subsidies that are channeled to them through something called the Community Reinvestment Act. Just to give you an idea of what I mean by big subsidies, the merger wave in banking generated contractual agreements between the big banks and urban activist groups that were part of the approval of their mergers, of agreements for 10 years at the time of the mergers of $2.4 trillion from 1992 to 2007. So I just want to emphasize, this is something a lot of people aren't really aware of if they're not operating in the banking area in the US, but the big banks have a constituency that's allied with them, which are urban activist groups and the Federal Reserve Board. And so it's these three acting together that are the three-legged stool that's propping up the inefficient banking system. And they have extreme incentives to try to oppose and mischaracterize fintech as risky, unnecessary. So you'll hear these kinds of things all the time from politicians in the US especially. Why would the Federal Reserve Board especially feel a threat from these non-traditional banks from a regulatory standpoint? And this is, again, a US legal point, but it's quite important. If you are an intermediary on either the lending side or the deposit side, and you come into existence without issuing deposits, so I want to emphasize the word deposit is essential. If you don't issue deposits, you are not subject to regulation under the Community Reinvestment Act at all, which means you're not subject to those mandated fiscal policy, off-budget fiscal policy transfers to these urban activist groups. Secondly, the Federal Reserve Board does not have oversight over your holding company. And third, the FDIC does not have insurance oversight over your deposits. So you'd still have your charter oversight by, let's say, the OCC, but it would be a very limited kind of oversight in the sense of not including the Federal Reserve Board or the FDIC. And even under the OCC, you wouldn't be subject to the Community Reinvestment Act. This is very important. So if you're a payment system provider and you find a way to create yourself without using the word deposit, that's hugely beneficial to you. And if you're a lender who gets a charter without being a deposit taker and doesn't make part of your business plan to take deposits, again, that's hugely beneficial. But of course, that's precisely what the status quo defenders don't like. So now let me talk a little bit about some examples of how fintech provides services currently, and then go on to complete the discussion by talking a little bit about a futuristic vision of how a stablecoin payments network could develop if it were allowed to, in a way that would be extremely efficient and inclusive too. And then I'll finish by talking a little bit about political forecasts in the near term. Okay, so many of you who are following fintech are probably aware of some of the firms that have been working to get these lower physical costs for connecting customers to them, or using servers to connect them more broadly. So that some of these firms are Chime, VeroMoney, Dave, MoneyLion, Even.com, PayActive, LendUp, Opportune, Personify, NerdWallet. So I could go on, but what they have in common is that they figured out ways to help people find alternatives to very expensive ways to borrow small amounts very quickly for short periods of time. And as I mentioned, that's where, whether it's payday lending or bank overdrafts, those are the key alternatives, and they tend to be very expensive. So this is allowing people to locate a bank. Suppose that you're a poor person, or suppose that English isn't your first language, and you need a little bit of credit. How do you find an intermediary? Maybe you're also one of the so-called credit invisibles, that is, you don't have a FICO score. So what you need is to find an intermediary that can get information about you from something other than FICO. So we've seen this new platform called RiskView that uses new kinds of information. For example, your record in paying your utility bills, or your record as a renter of an apartment. So using that kind of information, scraping the web to find out credible things about you, even though you haven't had a credit history because you aren't part of the traditional system. So then we can connect with you. Maybe one of your problems is that you have such a small need that the typical traditional banks' costs are just too high for you. Well, again, you just connect online, they get access to RiskView, and they can approve your loan. Or maybe your problem is that you don't speak English and you lack trust for the banking system. You're not sure who you should be talking to, who to believe. Well, they can set up special kinds of information for you where they provide access to independent sources of consulting in your native language that can help advise you, that are credibly independent from the intermediary. So the point is, online, a lot of things are happening that are allowing people of all incomes and all cultures to be able to access banking in all types of transactions speedily and without being dependent on traditional kinds of information. This is really exciting. The other thing to mention is that unbundling also tends to reduce systemic risk because you're separating loans from deposits. And so things like withdrawal risks related to the operation of a deposit system, for example, when we saw the breakdown of some of the interbank market during the crisis of 2008, and we saw some problems with wholesale funding. Those kinds of things would not translate from one side of the balance sheet to the other. There could still be problems with wholesale markets freezing up, that's for sure, which could have lending implications. But the point is they're going to be more localized in particular intermediaries and not necessarily huge intermediaries that can take down the whole financial system based on a problem on one side or the other. From a payment system standpoint, there's also security advantages having to do with reducing the potential for hacking and reducing the consequences of hacking. In a centralized system, it can be much greater because you bring down potentially the whole system, which in a decentralized system based on bilateral transactions through blockchain, of course, you don't have those same kinds of systemic risks. So I think it's pretty clear that these new technologies, especially if we can think of them as an alternative payment system that can develop via blockchain, could be more efficient, more inclusive, and also less systemically risky. So now let me just turn to talk a little bit about stablecoins in particular and how we can think about those. And I'll be wrapping it up in about 3 to 4 minutes. Okay, so what I want to emphasize is that stablecoins have been so far a very limited technology. So for example, there's a company called the Dowler Company that developed a pretty large stablecoin business in multiple currencies in the US. And the way it operates is you buy coins and then they invest them typically in treasury bills. They earn a slight spread over the money in treasury bills. So it's like a money market mutual fund. You have redemption rights. They are maintaining reserves, pretty much 100% reserves. In treasury bills, they're paying you a little bit of interest and they're pocketing the spread. Very little what I would call fundamental value creation. It's certainly not a new network that's been developed. It's just an account balance that allows you to earn a little more interest than you'd get from a checking account if you're comfortable holding stable coins there. As far as I know, many of these stablecoin providers don't have credible auditing. Some do, some don't, of their reserves. But it's also important to recognize there's very little value creation really going on here. They're just places to park your money. They're not really giving you a particular kind of transacting technology that you can use, for example, from your iPhone walking on the street to buy a cup of coffee. That's not what you're doing with these stablecoins yet. But you could. So let's talk about what's risky from a regulatory standpoint about this model first. So first of all, notice that even though these aren't deposits, by the way, money market mutual fund accounts aren't deposits either. They're not debt instruments in some strict sense, and they're not demand deposits in some strict legal sense, but they are quite similar to them. And it could be quite possible that regulators will simply deem to interpret the stablecoin balances as deposits and to apply the word deposit to them, which, as I already pointed out, would have quite big regulatory consequences. And they might also decide to require redemption and 100% reserves. That could be what would be required. If you do that, unfortunately, you will freeze the stablecoin business in this very early stage, very primitive stage, where it's not doing much in the way of value creation. And you will then foreclose a lot of options for what would be the really valuable thing, which is to develop a stablecoin network operating with a very different kind of payment system structure, much more efficient. So let me talk about what that alternative would be. First of all, you don't need deposits and you don't need redemption to get stable coins. I'll give you an example. Suppose that I take in $1 million of your cash. I give you coins, which I say are worth $1 million, and I promise that I'm going to maintain the value of them at $1 million. But I say, I'm not giving you a deposit, I'm giving you a perpetual preferred stock claim on my intermediary. That means you can never redeem it. It's not redeemable. But at the same time, I operate an algorithm that will buy coins on a secondary market platform if their price falls to 99 cents on the dollar, and sell coins on that platform if the price rises to $1.01. So I'm using secondary markets to give stability. That promise is credible if I develop an algorithm that actually executes it. And if I have, let's start with 100% reserves. If I have 100% reserves and I have a credible algorithm for exercising that, I will always be able to honor the promise of buying whenever the price is 99 or lower and selling whenever the price is 101 or higher. And therefore, you can get stable coins without a debt instrument and without redemption. And that's great because that means there's no way that you could be regulated by a banking regulator because you're not doing anything could be possibly construed as a debt instrument, much less as a deposit. The SEC will want to regulate your issuance of stablecoins probably eventually because they are preferred stock instruments, but that's a small price to pay. That's not going to be a big deal from the standpoint of consumer protection or costs or prudential regulation costs. I think something like this is probably the right long-run model. That is this structure of perpetual preferred stock. There may be other alternatives. I don't want to foreclose those other options, but I really want to push for this view because I think it's a pretty good one for people to, economists at least, to think about this. Furthermore, now you'd be doing some real value creation. You're operating in a blockchain payments network, which is much harder to hack and which doesn't have as much consequences and costs if it is hacked. It can operate at the speed of light, and the technology already exists. The patents have already been existing for this, to be able to, from your iPhone, walk around the street using that blockchain network at the speed of light, buy anything that you want from a local merchant, once the network is properly built out and those connections exist. Furthermore, and this is where the real value creation, in my view, comes from. Not only could you earn interest on those balances, but you could get new kinds of services, messaging services that accompany those. So the idea here is if you want to gamble online, you have to demonstrate that you're 18 years or older. You have to be able to send a message simultaneously with your gambling payment to be able to tell the recipient that you are 18 years or older. Or if you want to avoid tax fraud, you have to be able to commit sometimes to pay taxes on transactions, sales taxes. So you have to be able to credibly say what your address is. These new technologies are allowing lots of flexibility and what's called selective anonymity in being able to send messages at the speed of light along with your transaction amount to be able to execute complicated sorts of transactions as you see fit and to be able to provide whatever information is legally necessary on a credible basis. So this is a big deal. It's more secure as a network. It's richer in its ability to provide additional messaging services. You earn higher interest and you execute gross time, real gross time settlement at the speed of light. So as I pointed out, I think it's almost obvious that this is the technology that should develop as the right way to think about a payment system. And it would be an unbundled system. There would be no advantage from having lending going on within this intermediary. The intermediary would make money from fees that it would charge on its messaging services, and that would be its main source of value creation. So it would earn a small fee on spread between its reserve assets and its coin preferred stock, but its main revenues would probably come from the intangible asset of its technology for messaging. So just to say again, it would be, I'm saying we should allow the OCC to charter these kinds of intermediaries, not require them to be chartered, but give them the option of getting a charter and make it clear that they would not be deemed deposit institutions. They would not be subject to the Community Reinvestment Act, not be subject to Federal Reserve Board oversight, nor subject to the oversight of the Federal Deposit Insurance Corporation. The OCC would examine them, that is, it would look at their algorithms to make sure that their commitments, for example, to buying and selling in the secondary market, are in fact embedded in their algorithms. and make sure that other kinds of algorithmic commitments, I could talk more at length about this, for example, how to deal with problems that might develop in the intermediary. For example, you can sometimes have losses from fraud and where the intermediary might even go bankrupt, but we can deal with those kinds of problems algorithmically too. And also, most importantly, perhaps making sure that there's monitoring of the reserve balances that the intermediary is saying that it's maintaining. We're seeing right now lots of issues with Tether and other kinds of intermediaries where they say they have these balances, but it's not always obvious that they really do. So, of course, the incumbents, especially the Federal Reserve Board, the FDIC, the big banks, and those community activist groups in the cities, those urban activist groups, are going to hate all this. They're going to mischaracterize it as risky, as unnecessary, and of course, that's because that's what their special interests lead them to do. So, what I'll end by, this is my last slide, by making some predictions and offering some advice if there are any entrepreneurs watching this. So first of all, this first prediction was a prediction. It has already come true. So when I first wrote these slides, I was predicting what would be happening by the president's working group, but it's already come out with a fairly negative view of stable coins and wanting to, I would say implicitly, as we've seen many people wanting to stick them into the deposit model with redemption and 100% reserves and all of that. And that's, of course, that will kill the business. We don't want to see that happen. My advice to entrepreneurs is, if you don't like my model, come up with your own model. But you need to hire people in your firm that will advise you of how to steer clear of the regulatory costs and not just go with the current legal status of whatever you're designing, but thinking about the future of the way the regulators will try to redefine what you're doing or constrain what you're doing. If I'm talking to people outside the US, my main advice is don't listen to the conversation in the US and assume that it's real. Don't assume that it's a credible conversation about the potential advantages and the risks of fintech. Understand that the regulators, especially the Federal Reserve Board, and the Treasury Department, especially in this administration, have strong political constituencies that want them to oppose this, and that does affect what they say. And build a political coalition. I would say all of us should be getting the word out that there's big advantages to this economically, so that we can help support the creation of a political coalition that can overcome these special interests. As you all know, the biggest threat in political economy comes from the fact that special interests are always going to be better organized than common citizens. And so advantages that accrue to common citizens are often not occurring because special interests will block them. That completes my remarks. Thanks for your attention, and I look forward to answering some of your questions.